Hello and welcome to the Business of Property podcast. I'm Stuart.
And I'm Simon.
We're both property people running our own businesses, and this podcast is just us chatting, as we often do, about anything and everything property. And this week, our chat is going to start with a couple of quick updates. And I don't know if we want to signpost the rest of the episode, but we'll also be talking about exit strategies and long-term goals. So if that is of interest, please stay tuned, as they say. So Simon, we were talking about updates. Mine is probably going to be as quick as yours was in a couple of weeks ago. So yours might be a bit longer because you were speaking about your property that I remember some time back ago you were debating about whether or not to sell it, but there has been progress.
Yes, indeed. I'm not sure this update's actually going to be any longer, but it is now on the market. We made the decision to try and sell it a few weeks ago, and instructed an agent. It's taken a bit longer than we were hoping it would in order to get photos done, because there were some scheduling issues between the tenant that's there at the moment and the photographer and the estate agent. But that's all been sorted out, and it is now on the property portals. And the photographer has got some good photos. But the thing I sort of like most is there's also a virtual tour. So I'm a big fan of virtual tours on property listings. You can go and have a really good feel for the house without actually leaving your desk. And our property listing does include that. I'll make sure there's a link in the show notes so people can go and be nosy if they want. It's a 3-4 bed house down in Brighton. I think it's
wow. It's got curb appeal. I'm looking at it now. It's certainly got curb appeal.
Yeah, it's a nice big double fronted house, complete with garage and driveway. It's that definitely looks great from the outside. I mean, it looks good from the inside as well. And it's got a good back garden and things as well. It's very neutrally decorated inside. So I suspect a new owner, if they wanted it to be their home, would want to come and put their own preferences and own personality into the property. But yeah, it's nice and ready for that.
Very good. And in terms of the asking price, so did you look for many agents for this one? Had you already selected? Did you speak with a number? How did that?
Over the years, when we've been umming and ahhing what to do with this property, we have spoken to a number of different agents. Most of them have actually been sort of through my parents, who have other properties in the area and sort of converse with agents on a more regular basis around there. And this one was similarly chosen through my parents, who have a relationship with them at the moment. So that's how that arrived. We didn't really do much in the way of price comparison on the agent front. These ones aren't too bad by any means, but they're certainly not the cheapest you can get. So hopefully they're good, and we'll certainly find out how they're getting on in the next few days. The listing has only just gone live, so very, very early days yet.
Just a quick question as well on that one. Is it because obviously it's a nice big detached house, and are there many on that street in terms of detached?
No, there's almost all terrace houses. Some of them have been converted to flats. In fact, I think there might even be a dedicated block or two of flats, but they're all quite old style buildings. So yeah, it's pretty unique, both on that street and actually in the sort of immediate area as well. It makes it very, very difficult to try and value. So we shall see. It's got a asking price of 700,000 at the moment, and we're hopeful that someone, or in fact multiple people, will really love it, and it could even be bid up from there because it's such a unique property. But we shall see how frothy the market is or not.
Yeah, it's interesting because my update is much shorter in that we've got 2 flats on the market at the moment, and there isn't movement on one of them. We spoke, at quite lengthy terms about why there was an issue, and that was the flat in Croydon where we've got the cladding issue. We have since, though, changed it to a cash buyer.
Have you had much interest from cash buyers, and how have you found that sort of changed the people who have been inquiring and the responses you've been getting?
Well, The interesting part is that we're now looking at investment. So that's the key thing. Well, I think one viewing was a father and son, so looking for, I think it's the university or college in Croydon, and he was looking for a place for his son, and they were cash buyers. So we've knocked 50 grand off the asking price to try and gain that interest. It's not the price we necessarily want, and we're certainly not going to sell it. So we are investors ourselves. So we know how this works. But the investors that have come in, generally, I think there was two that have come with money from Hong Kong, and I've heard that anecdotally from a couple of people recently, and also on a podcast. So that seems like it is a thing, so to speak.
Yeah, I've just, again, anecdotally, but there are people registering with Patma all the time for the free accounts and the sort of paid for products there. And I've seen a reasonable number of those are currently from Hong Kong.
Yeah, it's interesting.
Yeah, very interesting.
And we've got, I think, 3 more viewings. So we had 3 cash buyer viewings, and we've got 3 more viewings this weekend. So we're hopeful of getting interest, but we're not in the stage where we're desperate to sell. I mean, we'd love to sell it because all of our capital is in it, investor capital is in it, et cetera, et cetera. And it was a project that was supposed to be done and dusted in a year, and we started it April 2019. So the less said about that one, the better. But
well, you've only overrun by a few months, and in your defence, you have had to deal with COVID-19 in that overrun period. So I don't think you're doing too badly.
Yeah, that's elongated it. I think it's just one of these projects where it's had more than one challenge. Let's just say that, and we can probably come back to that as a review at some stage. And one of those challenges is also the managing agent of the property, which, to be honest, because it's a commercial mixed resi, will certainly make me think twice before doing it again. Anyway, that's that. And then the other one we've got in Kingston, we've had several viewings. It's a studio flat. We haven't had any offers, and we're not sure why at the moment. We have dropped the price slightly.
This one really surprises me because it's a lovely flat. It looks really nice, and as you've said a number of times before, it has a definite feel of a much larger property because of the way the room is sort of separated out. It feels like a 1-bed rather than a studio, and I mean it looks great online. I don't know, maybe the photos are just really cleverly taken, and you're hiding something awful in one of the corners. I don't know, but looking online, it looks great.
Yeah, strange. I don't know whether, because again, the stamp duty removal we thought would really help, and it's an interesting one because the agent said, "Oh, well, there wasn't stamp duty," but my understanding was that for anything above 125k there is stamp duty. I think it was first-time buyers that didn't pay stamp duty. So up to 500. So maybe that's what he's saying. And I'm wondering whether or not Help to Buy is an issue. I don't know if a lot of new developments have gone up in the area. So again, we don't know what the external factors are. There could be that as well, because I think obviously
you're facing a lot of competition.
Yeah, I think that must be it. I think we'll give it another sort of 4 weeks before we think about what we do next. But it's a flat in my eyes that should be selling. It's a great flat, and we've talked about it before. So that's the update on that front. So next thing you mentioned talking about was potential exit strategies, which is a good topic.
Yeah, so this is unashamedly stolen from the property podcast. The 2 Robs spoke about this on a recent episode. They were talking about what property investors do sort of at the end of their investment journey, so their exit strategy. They suggested 3 sort of broad options. One was do nothing, so you just keep going. You build a portfolio, and then as your exit strategy, you probably stop growing that portfolio, but you just leave it as it is. Option 2 was you adjust that portfolio in some way. So perhaps you get rid of problem properties, you simplify properties. So perhaps you move from an HMO strategy, which is much more labour intensive, to a vanilla buy-to-let strategy, which is more passive, or perhaps you sell half of it to pay off the mortgages on the other half and simplify your life that way, or remove your concerns about debt or your potential stress around having debt. Or the third option was sell it all and just have a big lump sum to spend or invest in other means that are much, much lower effort. And it got me thinking about my own exit strategy and also sort of longer term goals for how to get there. And of course, got me thinking about the fact that we haven't really talked about our longer term goals or where we feel our property investment journey is ultimately heading towards. So, seeing as I'm the one who's brought this up, I'm going to ask you first, Stuart. What's your longer term property goal? And by longer term, I'm thinking sort of into retirement, not sort of 5 years, but properly long term.
Yeah, I understand. I when I started buying the properties, for me, it was always, I guess, a 10-year play. I think in my view on things, and as we know, time goes so quickly. I can't believe that, the first HMO property I bought was in 2015. I mean, the buy-to-let we've had for 15 years plus, but in terms of the HMO, and we bought flats before that, but the HMO strategy started 5 years ago, and I was sort of thinking, well, 5-10 years, we'll see where it goes. But of course, the longer term strategy for me at the moment, the way I think about it, is particularly in the business. And this is probably a topic I'd like us to pick up on another podcast. But given our podcast title is the business of property, it's really getting to people to think about their portfolio as a business. So what is that business? And it's really simple. In our first thoughts, well, it's just a rental business, but how does that business operate? Because otherwise, in my eyes, we are just landlords with a collection of properties. And that's, for me, why this podcast was always appealing, because we try and get under the skin of the business of things. I'm going around the houses in terms of answering this question. But for me, when I started the limited company, I then started to reframe my thinking around, okay, what is the business? Okay, the business for me was a student and young professional property business that was going to provide high quality accommodation. So I haven't really thought about the exit per se. I do have some thoughts around what I'd like to do with that business. Two of them are, well, number one would be I'd like to build a big enough business within the limited company that it would be open and appealing to potentially investors, and I'm talking more institutional investors. So, people that are aligned with pension companies could be, we're talking Hong Kong, and I speak with someone that has links with investors in Hong Kong. And so for me, that is something I would think about. And I've thought about how that would work. I haven't thought about it deeply, but I'm kind of just sharing my initial thoughts, really. So this is first dibs. But it could be around selling equity in that company. It could be selling the company as a whole. Part of me would want to hand some element of the business down to the family. And that is something, I'm not going to get all grandiose about it and say I'm doing this all for legacy. I would like it to be some of it, but right now that's quite far from my thoughts, because I don't feel like I've constructed anything well enough to think well enough about how I could hand the portfolio down, tax efficiently, et cetera, et cetera. So I think, to summarize, my thinking is around building a business, a property business that is generating significant cash flow. I mean, the income for the Lord Panda business at the moment, and we're starting a new brand called Inspired Urban. But we are 6-figure, turnover. So a good 6-figure turnover at the moment. It needs to be better, but I'd like to step it up significantly so that any potential investors can see a good business. So as you know more intimately than others, my focus is really about getting that business to work first and foremost, because I think until then it's not a business; it's a collection of properties that I manage. So hopefully that answers my question, and hopefully I didn't go around the houses too much to provide that thought. So I'll return the question to you now. So where we stand today, what's your thinking about when Mr. Pither has is in his 60s and the kids have grown up a bit, what's going to happen?
Well, I think I'd quite like a rest.
Okay, I'm with you there.
In terms of my property business, my property portfolio, I'm very much of the mind that I'm building a portfolio for the long term. It's not something that I intend to sort of reach retirement and suddenly sell off and have a lump sum. Properties produce a good, regular, ongoing, largely sort of inflation-linked income. And I would like to maintain that and carry that into my retirement. I suspect in the sort of 3 scenarios that the Rob's outlined, I will fall sort of into the middle one in terms of doing some restructuring. I don't have any very high maintenance or sort of non-passive property investments at the moment. So I don't do service accommodation, don't do HMOs. Mine are all vanilla buy-to-lets. So it's not that sort of adjustment. I wouldn't adjust out of that into anything simpler because I don't think there really is anything simpler. But I probably would look to restructure the debt arrangement. It was quite interesting. The Robs were quite keen on saying these days there really aren't any restrictions on mortgages into old age. You can get new buy-to-let mortgages while you're in retirement, and you can obviously keep existing ones as well. And they were also very keen on saying that there's nothing wrong with holding that debt and keeping that debt longer term, but there is something sort of emotional about holding debt, and it doesn't make business sense. I can fully admit that, but on an emotional level, I think I fall into this category that I mentioned, where it would be nice just to not have that debt, to not have to worry about what the interest rates are doing or finding a new mortgage product every 2 years or every 5 years. So I can well imagine that in those 20 plus ish years time, when I'm really looking at retiring and having a rest, the strategy I would pursue at that point as a sort of exit, if you like, would be to reduce the number of properties I'm holding and pay down debt on ones that I keep. So obviously I'd take the opportunity to get rid of any slightly problematic ones, or ones that are just sort of out of the geographic area that I'm working in at that time, and try to simplify my ongoing portfolio management and investment life as much as possible. Mm-hmm. Remove any risks or stresses around mortgages and interest rates and things, and make it really ultimately as passive as possible for sort of ongoing maintenance into retirement. And sorry, go on, Stuart. You were going to ask something.
I wasn't actually. I was just going to say it makes a lot of sense. And I think the challenge for me, I've never been a good one for projecting 10, 15, 20 years, because I think how we think and feel is something that we can't second guess. But based on the people we know and the people we've seen, I think what you're talking about, I completely subscribe to, because I think by the time you get to 60, 65, and I've met these people, I've bought properties off some of these people, they get to a certain age. When you've done it for 20, 30 years, you do get tired. And that is why we have the phrase tired landlords. And I completely understand that mindset, even though we just don't know how we're going to think and feel. I can totally understand at that stage, you don't want to be thinking about mortgage rates and interest rates. And the other thing that I was just going to talk about that you made me reflect on is, I'll always remember a conversation with someone I used to work with, and he talked about, and I've always thought this is very old thinking, but he always remembers the day that his father finally paid off the mortgage, because he said he came home from work and he said his dad was just walking around the house, knocking the walls, knocking a wall, knocking a door. I said, Dad, what are you doing? He said, I'm just touching all of these walls. And he said, well, why? And he said, because I own every single brick of this house. He said, I finally paid off my mortgage. And of course, it's a funny story. And I've always thought, but that's very old school. in terms of thinking, I'd always want to, utilize my money the best it can be done. And I have to say, I've had a few debates, and I hope my friend isn't listening that I used to debate this with, because he used to talk about paying down mortgages and said, well, why don't you start paying off some of those mortgages? I was like, no, I need to use that capital for growth. But now I have to say my thinking's starting to turn a little bit, where I'm more in agreement with you in terms of, actually, I think I'd prefer a bit more security. And it's probably come from the fact that I am very highly leveraged. So, we don't need to get into that, but I'm very highly leveraged, which means that, the payments are quite high. And if I put more capital back into those properties, I could bring that down and actually not sleep a bit easier, because I sleep well enough, but actually just have an easier work day, if that makes sense.
Yep, I can totally understand that. It's just taking one extra concern off the table. One other thing I think I would also change as I move into that retirement stage. Well, in fact, I think I might try to change this a bit earlier, actually. So I was going to say one thing I would change would be to remove myself from the management side of it. So currently I self-manage my properties, with the exception of one or two which my parents manage for me. And obviously, while it's low levels of work, it's some work. And most critically, it's that mental overhead of knowing that someone might phone you in the middle of the night and say they've got water pouring through their ceiling or some other fun thing to deal with. And I think I would want to take that away. So,
or at 3 a.m. say that they can't get in the house and they need new locks, as we had in the last week. But sorry, I interrupted.
Oh dear! And you said you didn't have any updates. That's so yeah, I would. I would definitely look to have someone else do the property management for me in retirement or in later stages. And my longer term goals, but not quite long to the level of retirement, would be to actually build up the portfolio to a level where I could have a property manager working to look after those properties for me. Possibly not a full-time person, but a dedicated person. Because I feel that would be the way I would prefer to go, rather than outsource to an agent or multiple agents in different areas. But I don't know. Never say never. I'm nowhere near that stage yet. So we'll see how things evolve over the next decade or so.
Yeah, makes a lot of sense. And the other thing, just in terms of the topic of conversation around always essentially taking money out and being happy to do that. And all of my mortgages are interest only. I don't have a residential mortgage currently, so they're all interest only. And I know there is this belief, and we look back on history, that property prices always increase. And I have been a subscriber of that. But I just think with events like COVID, with people like Donald Trump in charge, and we're not going to get into that, or we just don't know what the world's going to happen. We don't. There might well be crashes that are bigger than we could have ever expected that may reduce. We know that some properties in certain parts of the country are still getting back to the levels they were at before 2008 in certain parts. So
yep.
I do, sometimes I don't disagree with the principle that property increases in value. We know it does. We are investors. That's why we do it. But I think we still have to be, reticent around and careful around how we buy and what we buy for.
Yeah, the world is perhaps a less stable place these days than we give it credit for. And there have always been parts of the world that are less stable. We're fortunate enough to live and invest in parts of the world that are assumed to be very stable.
Yeah.
But yes, perhaps that assumption is not necessarily a safe one.
But I suppose doing what we do, the way I always mitigate that is obviously buying at the price that I'm happy with, and knowing that worst case scenario, if it were to lose in value, could the property still maintain itself? And that is always the answer. And with all of the testing going on at the moment in terms of the stress testing from banks and so on, you'd like to hope that would be the case. And I guess it rounds off what we're talking about, long-term exit strategies. You and I are talking about let's hope 20, 25 years time from now, that's a long time. And we'd hope that any ups and downs in marketplaces will have ridden over in that time. So it is a long-term play. And I think you and I are agreed on that. And that's always my frustration with a lot of the messages being propounded in the social media and in the media is very short-termist. Do this strategy, make your money, replace your income, do that in the next 90 days. It's all very short-termist, and I think property shouldn't be thought of like that. I think it's a mistake.
I totally agree. Property is very much a long-term game. It takes a lot of effort and it takes a lot of work, and it requires time to put those things together and to reap the rewards from it. So you've said that you've been investing proactively investing for 5 years, and looking out, we've got another 20, 25 years still to go on that. It's that sort of time horizon that I think people need to be looking at for successful property investment. Yeah,
it's obviously the caveat is we're not talking about refurbs and flipping properties. That's a very different strategy. And yes, there is short term. And I know property sourcing is all the rage right now. Property trading and sourcing for properties is the trade.
I think where I would sort of separate these things out is there can be short term property deals, as in sort of you buy a property, do it up, flip it. But in order to make it a long term sort of income, then it's a long-term job. You can't make a real fortune in property without it taking a long time. You might be able to make a reasonable return on a single project, a single flip, but that's different from a lifetime of income and investment growth.
Yeah, and it's very, very different objectives achieved in that. But I think we've covered a wide range there.
Yes, and run out of time again.
Well, as I kicked off, I should wrap this up rather. So hope you've enjoyed the show. If you've heard anything of interest or enjoyed it at all, please do let us know. Please do reach out to us via thebusinessofproperty.com. If you haven't already, why not? Please do leave us a review. We'd really welcome it. It just helps us get the message out there. Other than that, we'll see you on the next episode.